Good morning, everybody. I would like to thank you for attending the Place Your Trades Network Spaces. This Spaces is brought to you by Tradeabate, which has a custom web app dedicated to trading CME Group's new daily option contracts, including indices, energy, metals, and now Bitcoin. You can also trade these on the DOM on Tradeabate's main platform as well. They're a great way to get exposure to the futures markets with limited risk. You can use the link in my Twitter stream to get the Tradeabate app for free. I also write a weekly blog and daily pre-market overview on markets that you can subscribe to at placeyourtrades.com. It's absolutely free. I will be doing a summary of this episode and my key takeaways that will be available for download as a PDF. If you're interested in getting this PDF, you can click the link on my feed. I also put it up in the Nest. Or you can visit placeyourtrades.com/spaces to sign up for it. And the PDF overview will be available and emailed out to anyone that signs up for it. And now on to our guests. First, we have Mike Green. Michael is the Chief Strategist at Simplify Asset Management. Michael joined Simplify in April of 2021 after serving as Chief Strategist and Portfolio Manager for Logica Capital Advisors, LLC. And prior to that, Michael managed macro strategy at Thiel Macro, LLC, an investment firm that manages the personal capital of Peter Thiel. Prior to Thiel, Michael founded Ice Farm Capital, a discretionary global macro hedge fund seeded by Soros Fund Management. From 2006 to 2014, Michael founded and managed the New York office of Canyon Capital Advisors, a $23 billion multi-strategy hedge fund based in LA, where he established their global macro strategies, managing in excess of $5 billion of exposure across equity, credit, FX, commodity, and derivatives markets. Next, we have Matt Cole. Matt is the CEO and CIO at Strive Funds. Matt oversees Strive's investment philosophy, strategic positions, and product lineup. He is head portfolio manager for Strive's equity ETFs and its actively managed fixed income ETFs. Prior to Strive's, Matt was a portfolio manager at CalPERS, where he oversaw more than $70 billion in actively managed fixed income portfolios. During his 16 years at CalPERS, his portfolios were among the best performing in the investment industry and did not underperform their benchmark in any single year. And with that, welcome, you guys. Thank you very much for taking your time out of your busy day to spend this hour with us. So I'm going to start. Go ahead. I'll start with Mike, and we'll dig right in with the Fed. As the first question, consensus is there's going to be a pause with another rate hike at the end of the year, and people either seem to be in two camps. Either the Fed has hiked too much, too fast, or not enough. So curious as to what your stance is and why, and what do you think they're going to do today?
Well, I think this is one of these situations where consensus almost defines the underlying dynamic, right? The Fed is not going. Sorry about that. The Fed is not going to hike with consensus basically at 1 to 2% possibility of them hiking. That sort of surprise to the market would not be consistent with their overall messaging. I think what everybody is really going to be watching for is the summary of economic projections and the revised dot plot to really identify whether the Fed has moved to a much higher terminal rate view, moved off the 2.5 that's largely defined their longer term projections, and what their kind of language then comes out in the Powell press conference about the possibility of a rate hike in November. I think most people are expecting there'll be at least some indication that that's the expectation, but there's almost certainly going to be more of the underlying dynamic of we have additional incoming data, we will be responsive, et cetera, et cetera, et cetera.
And what are your thoughts on the yield curve inversion? Is it different this time, or are we assuredly to see a recession?
Well, I mean, look, I'm very clearly in the recession camp. I've been early and wrong on that, although I would argue that the focus on oil and the retreat in oil from June of last year, July of last year, created capacity in the consumer balance sheet that is, broadly underappreciated. That's now obviously come to an end. So I think we're headed towards that recession. We're seeing all the indications of it: rising delinquencies and defaults, bankruptcies are rising in the corporate sector, unemployment claims are rising, albeit modestly. And in the last report, obviously, we saw an unemployment jump that was largely tied to significant revisions that have been made. Listen, I think that we are probably on the cusp of, if not already in a recession. And when that tends to happen, all sorts of revisions will end up occurring that tell us after the fact that it's actually occurred. So to answer your question directly, no, I don't think it's different this time. If anything, I think the speed at which the Fed has hiked has created an element of shock in the economy in which people have not made any real attempts to refinance much of the paper that was printed in the low coupon era. That has in turn prevented an immediate impact into the economy, even as segments of the economy benefit from higher interest earned on their, CDs, money market accounts, et cetera. And so we're at this, weird handover point where eventually these higher interest rates are going to pass through. We just haven't really seen it happen yet because the transmission mechanisms that traditionally would have done it, high use of commercial paper, very short-term financing, that really hasn't yet. That was damaged after the global financial crisis. It never fully recovered, and so there's much less short-term paper in the market financing the vast majority of businesses. We are absolutely seeing that stress emerge in the levered loan space, commercial real estate, et cetera. I just think that's the canary in the coal mine for us this time around.
And Matt, I'd like to kind of get your thoughts on the same subject.
Yeah, so for the Fed today, it's not that particularly daunting. We're at the tail end of a hiking cycle. And, maybe there's another hike in November or December. That's really probably what's most at play today. But from a communication standpoint, I think it would just be much easier for officials to project one more increase. So that's largely what I expect today than them to proactively start to communicate against that. But whether they ultimately end up hiking or not one more time, to me is not the most important thing. What I see is we're at the tail end of a business cycle, and whether Mike's right and we're literally at the goal line and working into a recession right now, or if that's a late 2024, 2025 scenario, which is more my base case, I think that's getting a little bit, it's fun. It'll be fun to debate, but it's a little bit into the weeds. I think we're at the end of a business cycle. The Fed has obviously hiked a lot. I would argue that they've hiked probably about the right amount, maybe a little bit too much, but that, I see the 10-year as an example remaining in a range for the next market cycles, probably out to like 2030 of 3 to 5.25. So I don't see a lot of near-term movements to push us in a recession. I think that the data is still fairly strong. It's obviously weakening, but I would take the opposite side of a recession right now or the next few months, but in total agreement of where we are in the current business cycle.
And then back to Mike, I wanted to know let's start with zero DTE options. Are they actually moving the market, and do they pose any systemic risk, since it seems to be all anybody can talk about these days?
Well, I would conservatively put it in one of the most successful product launches in history, right? So it's gone from basically non-existent as an asset class to today representing, about 55%, 50 to 55% of any daily option volume is actually occurring in the zero data expiry options. The flip side of that is about 85% of that volume is actually dealers trading amongst themselves to hedge out their underlying exposures. And on the retail side, which is what everybody focuses on, that's only about 5% of the total volume. Institutions about 10%, institutions bias to sell, retail bias to buy. And to answer your question directly, I mean, in terms of a systemic risk, the real challenge with zero data expiry options is that they're, 0 day, right? They expire the same day. So it's a little bit like saying, like, is a craps table a systemic risk? Not really. The only way a craps table becomes a systemic risk is if you enter into a long-term contract where you're like, all right, I got to keep playing, and I'm going to keep, I'm going to borrow money, right? I'm going to open up a line with the casino. And that's the key difference is zero data expiry options don't create that long-standing liability. And so the process of influencing market outcomes very much impactful on a day-to-day basis. There is absolutely a risk that is being created for a significant single-day event in which the market's gap and dealers are openly exposed to that type of move that could impair risk-taking and then lead to a further event. But the options themselves are really, the story is much more about, is it an opportunity to take more money from gambling retail that thinks they're playing with zero commission options, opening up some avenues of hedging, but most importantly, that hedging is actually now liquidly available to the dealers who don't necessarily have to transact in the futures market where liquidity is more challenged for them.
And then as far as just the market is concerned right now, the market seems to be powering ahead with just like a handful of stocks kind of leading the way. We're over the 200-day, but over 60% of the stocks are like under the 50-day. So, where are the risks? Where are the inherent risks in this? Or is just this all passive investments? Or, are we at risk of some sort of crash, for lack of a better word?
Well, the single day risk of a crash is what I was referring to before, right? So if something happens that pushes you outside of the range in which the zero data expiry options can be liquidly hedged, that could create a situation in which dealers are chasing or in which individuals, whether institutions or retail, obviously less so, find themselves underhedged. And I think in general, the position that I see in markets is that most hedges are now being done with put spreads as compared to puts. There's obvious reasons for that. It is cheaper. There has been a very disappointing vol environment over the past 2 years that has damaged many in the vol hedging space. And so the market is not hedged to any significant degree. In fact, things like implied correlation and extreme out of the money options, deep out of the money options, those are priced about as cheaply as we've ever seen them. In other words, there is no real pricing for a crash. The flip side for that is we also have not really had, a 1987 style market crash for the very simple reason that there's circuit breakers and there's less, there's more regulatory awareness that these things can happen. So I think that the much bigger risk is actually that we were just experiencing some form of a gap on a daily basis that stresses the zero data expiry options. And then we wake up and the dealers are impaired, balance sheets are impaired, and there's much less risk taking. That then sets out a decline. But the crash, I'm kind of less worried about. I'm more worried about the potential for a multi-day or a sustained event.
I guess what I'm asking is this market structure uneasy, for lack of a better word, being that really it's only led by a handful of stocks at this point, where a lot of the, most of the stocks are underperforming, and yet the indices keep rallying.
Actually, most of the stocks are down, not just underperforming. The median stock in the market is now actually negative for the year. And fairly significantly. So, most people know at this point the work that I've done or are familiar with the work that I've done on passive investing. The mechanics of passive investing, in which money is allocated on a market cap, or more accurately, a float adjusted market cap basis, means that the most money goes into the largest stocks. And
What that means, unfortunately, is that they're presuming that liquidity scales with market capitalization. In other words, Apple at $3 trillion in market cap can absorb dramatically more capital than, let's just pick a random company, Delta Airlines, which is sort of near the middle of the pack. Unfortunately, the evidence in market structure is that that's actually not the case, that market cap does not linearly scale with liquidity. In fact, it actually scales as a square root phenomenon. And so that means anytime money goes into passive, it disproportionately affects something like Apple, Nvidia, Tesla, et cetera, that are the largest market cap companies. And it has very little to no discernible impact on some of the smaller companies within the S&P 500 or the Russell 2000. And so when we see this behavior, and in particular things like zero data expiry options, remember, are all bets on the indices themselves. There aren't really zero data expiry options structurally created for single stocks, and certainly not for the smallest stocks. It effectively means that if I want to hedge out that exposure, or if I want to arb between futures or individual equities, I will always buy my Apple exposure. I will always buy my Microsoft exposure. I will always buy my Tesla exposure. And so you're seeing much greater pressure from these types of activities on the largest stocks. And I think that's actually driving the phenomenon that we're seeing right now.
That makes sense. Thanks. And then back over to Matt. Matt, if we look at U.S. interest rates, U.S. interest expenses have surged about 50% in the past year to nearly $1 trillion on an annualized basis. So what can the Fed do about this, and what are the dangers of ballooning interest payments with tax receipts down?
Well, there's obviously a lot of dangers, but at the end of the day, we do have a debt problem in this country, and there's not a desire in DC to really cut spending. And so, I think that we're just going to be in an environment where the Fed will have to decide where they're going to set real rates. And I think that it's going to be some version of the so-called bonfire that we're going to see. And I think it's going to persist over the next 7 to 10 years. There's obviously a lot of different macro tailwinds to support higher inflation, but I think inflation largely it's going to stay above 2% largely over the next 7-10 years. And it will be an environment that is probably good. I think the Fed will never say this, but I think it's kind of by design for inflation to run a little bit hot when you have a debt problem. And that leads to a lot of different things. And part of we think about bonds, fixed income, of what is attractive, and we've already talked a little bit about being towards the tail end of an interest rate cycle. If you go beyond just treasuries into credit, credit's about average when you look at long-term historical spreads. High yield's about the same at the end of a business cycle. That's not something that's very attractive to own, in my opinion. Duration, I think, is not very attractive to own when you think about that sort of a macro backdrop. Or although I kind of see the 10-year right now as somewhat in the middle of what I see to be developing a likely range for the next 5 to 7 years of 3 to 5.25% ish. I think what is really attractive is something that we're seeing at Strive and we have in our total return bond fund. I think Mike's colleague Harley also is calling out a similar thing, and that's negative convexity. And negative convexity is relating to interest rate volatility, which is extremely high. And so when that's high, that creates some opportunities, and agency mortgages are actually really cheap, and something that we have a pretty large overweight to right now, and something that we prefer over something like credit when you're at the tail end of a business cycle and looking for opportunities to enhance yield.
So do you think, so in other words, I just want to clear this up, that the Fed is going to be forced to accept higher inflation rates, even though Powell says adamantly that they're not. Is that your assumption?
I don't think the Fed would mind interest rates remaining above 2% for the next 5 to 7 years.
Interest rates or inflation?
Inflation, sorry, inflation.
So why are they directing so firmly against that and hiking interest rates as aggressively as they have done?
I think that
in your view,
inflation, let's say in the neighborhood of 2 to 4%, is significantly different to me than inflation in the 5 to 10% range. And I think that they were concerned about inflation getting out of hand and hiked rates very, very aggressively to try to have some control of that. But I don't think that they'll really mind inflation at 3-ish%.
Your thoughts, Mike?
I think there's an awful lot of this view, effectively, that the Fed is, talking us down into the 2.5% range on a trailing basis, and then will allow inflation to persist. I think that's somewhat priced into the break-evens. I think my problem with it is if I look at shorter dated metrics of inflation, looking at the month-over-month dynamics, particularly in components that Powell certainly has alluded to have been a primary focus, those are actually running way below the levels of inflation that we experienced prior to going into the COVID crisis. The average for the core services, ex housing, ran about 2.5% over the period prior to the COVID crisis and the subsequent inflation. And today that number is running about 1.5% on an annualized basis using the last 3 to 6 months. It's strange to me that the Fed has not been more open about the progress that has occurred on that. And my general sense is that they are very much managing through a rear view mirror, and are not going to stop until inflation is actually meaningfully below 2%. Unfortunately, I think that's the direction that we're likely to go. The question that I have is if they over tighten or they extend their tightening path for too long, because I do think that that's really the critical component, is the passage of time and the rolling over of the contractual relationships that debt contracts represent. We're now at a point where we're seeing rapidly rising levels of bankruptcies. This is empirical. This is not my assertion. We are seeing significantly rising defaults, delinquencies, et cetera. It is particularly true in the younger generation that was not asset rich, meaning cars, houses, et cetera, coming into this environment. They were forced to pursue those properties and those capital goods at elevated prices with very low interest rates. Now the interest rate story has flipped around on them, and we're seeing, real levels of distress beginning to emerge, particularly for those under the age of 35. Who did not lock in their houses at super favorable interest rates. So, my gut tells me that we've got a deflationary episode ahead of us, and the reaction function to that is really going to be the interesting tell. I think the Fed is going to be very late to actually respond to it, precisely because they do remain so concerned about inflation. And as a result, I think that raises the odds that we actually have a substantive credit event at this point.
Mike, what is your view on, so if we have a credit event, recession, totally agree that we would have likely through that a period of inflation under 2%. But when you look out over like a market cycle, do you view the next full market cycle, call it out to 2030-ish, that there will be inflationary pressures, or do you think that the Fed will be able to control it and we will see longer term inflation or average inflation over the next 5 to 7 years below 2%?
I think it's very hard to say, right? Because again, it depends on the response function that occurs, both the Federal Reserve's response function and the fiscal policy coming out of Washington. In general, I am very much in the camp that says the entire world has adopted, the Charles Goodhart view that aging is inflationary because it fits the current facts set. the data actually and the analysis on which Goodhart's work is relying suggests the exact opposite, right? That an aging population is deflationary because what's really driving an aging population is decreasing population pressures. That's what I actually think we have ahead of us, is a largely deflationary environment that can be offset and exacerbated by a combination of fiscal policy and really aggressive monetary policy. But it certainly feels like we've chosen to go in the opposite direction for right now. So I actually think there's a very real chance that we get a much worse than expected outcome in terms of deflation. And then it becomes a question of how do we react? And I think right now the obvious answer would be that we would react and pump more stimulus through the economy, which in turn sets up the inflation concerns that I think you and I both share, or what I would more accurately describe as price instability created by the Fed's reaction function.
Do you, either one of you, see any scenario where we have stagflation, where we have increasing energy prices, yet decelerating economy?
Well, I think that's what we're experiencing right now. I think this is the only part of the stagflationary episode that is actually occurring, and unfortunately is one that I think a lot of people correctly foresaw. When energy costs go up, that's not actually inflation, right? That's actually a tax that is being levied against the consumer and reducing their ability to purchase other stuff. It can be enabled as inflation if the response is, okay, we're going to artificially keep energy prices low, or we're going to send checks to people that allow them to afford their gasoline costs, the increase in gasoline costs. But the actual act of energy prices going higher is deflationary to most goods and services, not inflationary.
Matt, do you have any thoughts on that?
Well, just as far as the general view on energy and oil, we definitely have a very bullish view on oil over the next couple of years. See it probably largely trading above $100 in the, call it $100 to $150 range, and potentially breaking above it after we get through whenever the next recession happens. When it comes to different secular factors and drivers of inflation, to me, I see a few. One of them being the mass retiring of workers that we've seen over the last few years. I think that's going to continue to cause wage pressures. Another one that I think is going to continue to persist is trends of deglobalization, both nearshoring and onshoring. And I think another thing that causes some inflationary pressures, because I think heightened inflation, if we do have that, deglobalization, if that trend does continue, also will lead to sustained heightened geopolitical tensions. And if that sort of scenario plays out and you have oil prices remaining elevated, I think that's one where inflation will continue to be annoying, be sticky in the economy. Although even in periods of heightened inflation, if that's what we have, it will be jumpy. And I do agree that a recession scenario likely in the short term would lower inflation pressures.
And then, since you brought up kind of deglobalization, I did have a question about that. Do you think going into kind of this era of scarcity, particularly in the natural resource sector, that we see more resource nationalism, such as we're kind of starting to see now with, say, India banning rice exports, and this isn't the only country that we've seen this trend. You think that trend is set to continue?
I think it's a trend that will continue, and it will have short-term times where it looks to be moving in a positive direction, but nationalism across the globe, I think, will continue. I also believe that if this scenario does play out and we have heightened geopolitical tensions, things like net zero 2050, I think you start to see less cooperation around the globe, and those sort of targets, those sort of commitments of working together, I think, continue to decrease. And I do believe that in this scenario, you will see countries looking out for themselves with regards to scarce resources.
That makes sense. And then I have to bring up, of course, the BRICS currency, or talk of the BRICS currency, and de-dollarization seems to be all the rage. So I'm curious to either one of your thoughts on this sort of scenario, and is it even possible, within the next few years or the next 20 years? Either one of you can
Sure.
take that one.
Sure. Heightened geopolitical tensions, I think, will continue to push for things like a BRICS currency. I do think that the globe would love to move away from the dollar. It's going to be a very difficult thing to do, but do I see the BRICS currency continuing to gain some adoption? I do. And we can talk about what we would like to see versus what I think is most likely to see, and those can be two different things. And I think you'll see some adoption for that. I also think that it's going to continue to work as a favorable tailwind to things like Bitcoin. And over the next 10 years, I think that all these things, heightened inflation, heightened geopolitical tensions, deglobalization, will have people want to move away from the dollar to the extent they can. And I think that will be something that will result in a bearish trend for the dollar over the next 7 to 10 years.
And your thoughts, Mike?
Yeah, I mean, I think I agree that a lot of people would like to get away from the dollar, but part of the reason they want to get away from the dollar is the liquidity that actually creates. Give me 1 second, I apologize.
All right. Well, we'll come back to Mike again. So I'm going to switch it up again a little bit here. Oh, you're back?
Sorry about that.
Go ahead.
Sorry about that, guys. I actually am a guest in a friend's home, and they were actually walking out. Look, I agree very much that people want to leave the dollar, but part of the reason that they want to do that is the flexibility that creates for them to finance their own ambitions and objectives. I see no country around the world, certainly not those that are proposing the BRICS, committing themselves to a strong currency process. And so, when I hear the idea that the US dollar is going to move into a downtrend, I think it's possible that could occur. And effectively what is being implied there is the idea that there will be a release of US currency that's currently being held as a reserve in exchange for other currency, or domestically held stuff, or gold or whatever. It's possible. It's hard. It's very, very hard. And I think the game is the Americans to lose. Doesn't mean we're playing the game particularly well right now.
All right, thank you. And then I wanted to switch gears again here a little bit, and talk to Matt. I was just curious. You worked at CalPERS for 16 years. So, what is the pension fund system looking like? Particularly, how are they faring with rate hikes? I mean, is it last year we kind of saw a near pension fund crisis in the UK? Will that, or could that possibly happen in the US?
It's definitely a challenging environment. And if you look at CalPERS as an example, their current funded ratio, I think, is around 73%. It's down quite a bit over the last couple of years. And part of that has been just the rough few years for bonds and equities, and those correlations kind of moving from negative correlations to positive correlations. That's a very difficult environment when their hedge has typically been bonds. And so it's a very challenging environment, because you have right now, as more and more people are retiring, one of the big changes that's happening in pensions in the United States is that for the last several decades, there's been net inflows from employees that are contributing to the pension, putting in greater inflows than the retirees that are retired and retiring taking out. And that basically is flipping as we speak. We're at a place like CalPERS, they're right at the precipice of, they might already be there, they're either right there or they're there, where flows are turning negative. And that is a huge problem when you're underfunded, you're 73% funded, and now more money is going out every month than going in. And so when you think about that as a problem, it's a huge problem, and it's a huge problem for people specifically that are millennials and younger, not looking to retire for decades. And you know, I'm one of them and have a pension currently at CalPERS. And when you start to look into it, the math is really hard, but the current people that are retired at pension funds like CalPERS are taking out right now 100 cents on the dollar from a pension that only has 73 cents on the dollar. So what that means is, absent an intervention, heightened returns above their targeted returns, or putting in excess money, which is not being done, the actual funded ratio for millennials and younger is much lower than 73%. And I had done some research on this, and it's probably under 50% when you actually start thinking about some time value of money in this equation. So there is a huge problem in the pension industry. It probably is not a problem that will be addressed or really talked about in the near term, but in the longer term, there's a massive problem there.
And would that be the same for Social Security?
Absolutely. It's I mean, at least there you have the federal government that controls the money printer. When it comes to a state pension, it's a order of magnitude worse, and especially when you look at a state like California that has on the margin more people moving out of the state than moving in. The majority of tax receipts in a state like California come from cap gains from the tech sector. So if we do have even just a market cycle right now that's more of a value market cycle than a growth market cycle, and cap gains remain very depressed in the tech sector in California with net migrations out of the state, tax receipts in California will be bad, which will then constrain the ability for the state of California to fix the problem. I think that Social Security is a massive problem, but I think the problem at state pensions is actually worse.
Mike, did you have any thoughts on either pension funds or Social Security?
So I agree with a lot of what Matt is highlighting. I also would highlight that we've known about this for a very long time, right? So one of the critical things to remember about the increase in government deficit is all we're seeing is off-balance sheet liabilities in the form of unfunded Social Security, Medicare, et cetera, come onto balance sheet, which requires the creation of debt, right? We see this in the corporate space all the time. If we actually look at the published reports or the CBO's analysis of the value of unfunded liabilities, inclusive of Social Security, Medicare, et cetera, they actually were flagging exactly this phenomenon, 15 years ago, and we've done nothing about it. And so I think that Matt is correct that, we've kicked the can and kicked the can and kicked the can. We've failed to address it. Unfortunately, the answer is actually going to be higher taxes rather than reduced spending, because we are contractually obligated to make this spend now. There will be some productivity gains. I've highlighted this, that a lot of the forecasts for totally unsustainable expenditures are largely tied to expectations of continued inflation in healthcare. If you had done the same calculation back in the 1920s and looked at it from the standpoint of tuberculosis, you would have said, oh my gosh, we're going to be spending 50% of GDP taking care of people who are incapacitated by the tuberculosis bacteria. And obviously today we won't spend anything on it because we came up with solutions. The equivalent today is obesity. Many of the diseases associated with aging, things like Alzheimer's, et cetera, consume a disproportionate amount of the resources that we're spending. And we are developing technological cures to those that will both raise productivity, improving the potential for the U.S. government to increase taxes or increase tax take, as well as reduce expenditures. So I'm not quite as bearish on a lot of that stuff as Matt sounds to be. On the flip side of the equation, as it relates to the state pension plans, I completely agree with them. I mean, these are, semi-private entities that do not have the capacity to print their own currency to meet these obligations in deflated terms or inflated terms. And as a result, are likely to experience an extraordinary amount of stress. And I think he's right in flagging a place like California, which, presumed for many, many years that it was going to continue to be the land of opportunity and experience positive population inflows. As soon as those turn negative, it becomes no different than Detroit or any other, Midwestern farm town. It becomes an increasingly unattractive place to be, regardless of the weather. And I'm actually sitting here in California right now, and I will tell you, the weather is spectacular, a lot better than the East Coast. But he's right. I mean, that is a real problem. The issue, as I see it, as relates to those, is that many of them have actually aggressively moved into things like private equity, venture capital, et cetera. Those are very different contracts than deciding to buy the S&P 500 or invest in a liquid mutual fund. You've created a series of long-standing obligations in terms of commitments to those funds and a presumption of the ability to access liquidity from the companies that are held within, either going public or being sold or dividend recaps, et cetera. The high interest rate environment changes all of that. And it is meaningfully impinging the liquidity dynamics associated with these pension plans far faster than they had modeled, particularly when you start thinking about the dynamics that Matt is highlighting, that they turn negative in terms of their inflows. Right, so we're actually looking at a really interesting situation where many of these pension plans, ironically, are going to be forced to sell public equities in order to fund their venture capital or private equity allocations, or private credit for that matter. It's going to be an interesting challenge, a really, really interesting challenge. I think anyone who tells you they know the answer to this outcome is playing a movie in their own head that they can't possibly know the answers to.
Well, that's excellent. And then I want to switch. Oh, I did want to ask. Student loans are going to have to be are going to be paid back starting in October. So, do you see this actually affecting consumer spending in any kind of meaningful way?
Well,
or being a drag on the economy in any meaningful way?
Well, I think, interestingly enough, it's going to be a drag on both fronts, right? So it is a tax effectively because it's proceeds that are being paid to the government. So it's not going into the banking system. It's not creating private sector profits, et cetera. It's actually, we're just transferring amongst the private sector. It's actually going right back to the federal government that has had to issue an increased amount of debt. California state collections, by the way, to stick on the state of California, which hasn't had to pay taxes until October 15th, that's going to be another significant drain of liquidity and cash on the economy that is currently cash that's deployed in things like money market funds, et cetera. So, I think that's another nail in the coffin. I do think it ultimately has to impact. I think you've seen an element of a bit of a surge of repayments that have come in early from people who might have accumulated enough resources to make a significant dent or to positively push it down. And those that are left are going to be kind of the ones that are either choosing not to pay or experiencing increased stress, and they'll experience the degradation of their credit quality, their access to capital, et cetera, that accompanies all of that. So, long story short, yes, I think it's going to have an impact. The question we don't know yet is what is the profile of how those outflows affect, everything ranging from other forms of credit to consumer spending, for the very simple reason that we just don't have the granular information yet on who is actually repaying and who's not repaying.
Matt, did you have anything to add to that?
No, I thought that was a great answer. I'm in agreement with Mike on that.
And then I have a question. This is for both of you. So, I'm kind of the belief that, heading into this election year, we're going to see even a bigger divide between fiscal and monetary policy as this administration tries to stave off a recession. So, what are the risks involved in that, or do you even see that being a problem?
I don't see it being a problem on a massive level. You're 100% right that on the fiscal side, they're going to try to do things to protect the economy moving into an election. You do still have, though, a divided Congress, and I think that's going to be a constraint on the ability to go full hog wild in spending policies. So there is definitely a conflict there, and it's a conflict that's going to persist. I don't see any scenario, even after 2024, where there's a change in guard with resolve for austerity measures in the United States. I mean, when we talked about the pension problem, we talked about kicking the can down the road and how this has been a problem for the last 15 years. It absolutely has. And I think when it comes to the fiscal side, I think you're just going to continue to see out of DC spending that might be at odds with what the Fed might want to do monetarily.
Mike, did you have any thoughts on that?
Yeah, I mean, I would just emphasize the divided government aspect of it. I think it's going to be difficult to get significant stimulus through to the economy, barring the extensive use of executive orders to create various forms of deferral of payments of debt. And, you could see shenanigans like, somebody in Wisconsin stubbed their toe and therefore it's national emergency. We're going to delay tax payments until November of 2024, right? I don't know actually the numbers, and I don't know how they're going to do it. I agree that there will be multiple attempts and shenanigans because holding on to power is ultimately the first is the prime directive, and making thoughtful policy is very much the secondary issue at this point. But I do think we have to acknowledge that it is a divided government, that there is actually a tremendous amount of resistance about various forms of spending. Particularly those that are targeted towards the lower end consumer, ironically. And so, again, we don't know the answer, but I do think that it's going to be more challenging to create the sort of stimulus that you had under the unified government of Biden's first 2 years.
That makes sense. And then final subject before we do the final round, I kind of want to talk about ESG a little bit, because I'll start with Matt on this because I know you've talked a lot about this. Do you think companies are putting ESG ahead of shareholder interests? And might we be seeing some sort of reality sink in with, say, Vanguard leaving the Net Zero Banking Alliance and the Net Zero Insurance Alliance has all but disbanded?
Mm-hmm. Yeah, so this is our bread and butter at Strive, and the problem that we see across corporate America is a movement away from shareholder primacy. And that is that the purpose of a for-profit corporation is to maximize value. And where are we? Is there a shift in winds? I mean, I think it's pretty clear that in a growth environment that we've experienced for the last 15 years, it's very easy to do things that might cost some money at the margin because stocks are in an environment that they're rising very rapidly. So it's a tax that could go unnoticed. That's not the environment that we are in now, and it's part of the reason why you've seen the question of does ESG with regards to ESG funds, do they outperform, do they underperform? Well, they outperformed in a growth environment, and now they're underperforming in an environment where value and energy are outperforming. And so to me, that's the less interesting thing. But the more interesting thing is where are corporations focused and what is the incentive system across corporate America? Because I do believe in the Charlie Munger saying of show me the incentives and I'll show you the result. And if you look at the incentives, and the incentives specifically kind of referring to, if I go back to Larry Fink and the Deal Book conference with Andrew Ross Sorkin, where people that are following this, he made some famous quote that was, "We are forcing behaviors." And what he was talking about was that to change behaviors across corporate America, you have to change incentives. You have to change incentive compensation. And so back in 2011, almost no companies in America tied executive compensation at the C-suite to ESG or DE&I measures. Today, 75% of the companies in the S&P 500 directly tie incentive compensation to ESG and DE&I measures. That is a massive change. You are now directly incentivizing non-financial interests at the C-suite level. And so this year, when you saw things like Vanguard pulls out of the net zero, you saw headlines, if you're following, that in this proxy voting season that BlackRock voted for, I believe, 9% of ESG proposals. That was down a lot. Vanguard was even less than that. You might initially say that the large asset managers are changing their tone, but they actually say something different. They call out redundancy, but second, they've also already achieved the objective of directly incentivizing the behavior at the C-suite level, so they don't have to force it in as much via the shareholder vote. And so that's what I actually see happening there. And I do think it's a massive problem, and it's not a problem that is solved by just stopping where we are. I think to actually fix the problem and incentivize the long-term value creation at the C-suite level, you need to remove those incentive compensation structures that have been implemented over the last 10-ish years across corporate America.
So, Matt, just very quickly, do you view diversity itself as contra to creating value at the corporate level?
Not contra, but not additive. I think that when you think about hiring, that you need to hire the best person for the job, regardless of gender, regardless of race. I mean, this is an example. BP is currently looking for a CEO, and there was this big push from some Bloomberg reporters about how that BP needed to make a statement, and that the next CEO needed to be a woman. I think that is actually very value destructive. Now, if the best candidate's a woman, they should absolutely hire a woman. But I don't believe that diversity by itself adds to performance. I do think that hiring is hard, and hiring meritocratically is hard. And I do believe that people tend to have implicit biases to want to do things like hire someone that they might want to be friends with. I do believe that there are challenges. I do believe that there are challenges to being a woman in the workforce. I do believe all those things. But when it comes to hiring decisions, we should not constrain our hiring decisions by trying to look for someone of a certain gender or a certain race. I think that's value destructive.
So I agree with you that the observation by BP that they're focused on hiring a female CEO is likely a value destructive activity, and it's almost certainly a value destructive activity for any one individual firm to decide that they're going to constrain their individual choices. And by the way, to be very clear, I'm not a fan of ESG, and I'm certainly not a fan of BlackRock attempting to wield the power that they did to try to drive forward, Larry Fink's unearned perspective on the way the world should work, right? So I think we're actually roughly aligned on that. I do think that there's very limited evidence that an increased emphasis that basically says, look, here's a checklist of things that we really should make sure that we've considered, right? What are the characteristics of our current labor force? How does that indicate potential implicit bias as you're describing it? Could we be more thoughtful about considering a broader range of candidates rather than just a bunch of Ivy League grads for roles in various institutions? I think there's actually value associated with that. But I agree with Matt that the constraint component, I just don't think it's nearly as dire as has actually been made. and would suggest that compensating executives on the basis of it is we have no evidence in any meaningful way that that has led to deterioration. In fact, many of the companies that have actually adopted these policies are among the best performing companies precisely because they have so many resources available to them. So it's not like I'm less enraged by it than I would suggest the current narrative is. And I think, like many things else, ultimately this too shall pass. I do think something that was really important that was said, though, right, which is a restatement of Friedman's shareholder value principles and the idea that the corporation should only be organized for the return of capital or the maximization of capital for shareholders. One, that's part of the reason why you actually have state regulatory environments to actually place limits around those behaviors. Because it could be maximizing for any one company to decide, you know what, we're going to nuke everybody else's gold so that our gold is no longer, is the only available gold, right? Goldfinger attempted to do that in a James Bond film. That could be a value maximizing activity that would be catastrophic for society as a whole. And so we have constraints that are placed around those behaviors. It also has nothing to do with actually the structure of a corporation itself, which is simply a mechanism of organizing to improve the efficiency of transactions so that they're happening in a non-market or a non-taxed way. This goes back to Coasian theory of the firm from 1937. So, like, part of the problem, I think, is that a lot of the stuff that Matt is saying has probably gone too far. We see many corporations engaged in societally damaging behavior. I actually don't think the fossil fuel companies are the worst of those. I think, there's many others that are far worse in a lot of ways. And I just have a hard time getting that worked up about it, on the ESG front. I actually think we all kind of acknowledge that we do need to transition, or we will transition away from fossil fuels, particularly for energy, as we have transitioned away from various other forms of energy in history. And there is a real value associated with the government in creating incentives to do so. I would prefer to see that take the form of funding basic research or funding implementation, similar to the rural electrification dynamics in the 1930s, rather than deciding, okay, we're going to try to use one of the most obtuse tools in history, corporate pressure through, voting in large public companies to try to influence outcomes. So, it feels to me like we're actually not really being serious about any of this stuff right now, is I guess the bigger takeaway I would put on it.
Do you think that the ESG narrative kind of gets distorted when you look at, let's get away from the companies, but of these financial products, say all these ETFs, if you've looked in half of these, ESG ETFs, there's nothing ESG about them.
Yeah,
and yet, managers.
Yeah, Tracy, I think you're 100% correct, right? It's a marketing label. And really, I don't think Larry Fink actually tied any particular attachment to it. He was just looking for an opportunity, given the dynamics. BlackRock has an internal system, Oasis, that allows them to very effectively manage the underlying assets. He was effectively just trying to create a further competitive advantage for BlackRock, right? The ability to offer low-cost products that qualify for pension plans and retirement plans, protect corporations or RIAs from lawsuits against hiring higher-cost purveyors of products. And create effectively a barrier to entry. He was doing what every corporation does. He was seeking competitive advantage. So I think the whole thing is kind of nonsense. I don't think it's had anywhere near the impact that everyone thinks it has. Oil companies did not stop drilling because of ESG. They've had to deal with high costs and challenges throughout history. It is very frustrating to watch things like Biden banning drilling in the Arctic National Wildlife Reserve. I just think that's kind of silly. But at the corporate level, I think it's a totally overblown phenomenon.
We obviously take the other side of that, and just a couple statements of response. One would be, to me, the biggest, I think, commitment that I've seen that would be in disagreement with kind of this is overblown and nothing has actually really changed at the corporate level. It would be the 2019 Business Roundtable Coalition, where 181 CEOs of American corporations signed together to literally, quote, move American companies away from shareholder primacy. They pledged to do that. And so I think if we're going to take the bear case would be they pledged, but they weren't serious. I think what we've seen over the last 5 years, to me, shows that they actually were serious with pledges and many of the different changes that have been made. And then secondarily, with regards to different targets, what we need to do as a society, I think that's a very fair conversation to have. To me, the important caveat in that conversation is, where do we have it? And if we want to talk about net zero by 2050 or reducing emissions or all these different things, great, let's have that debate, let's have that discussion, but let's have it through our democratic process where the citizens, through voting, decide to help set the regulations for which corporate America, then if corporate America is quote unquote the arena, a sports game, once the regulations are set, corporations maximize value. Corporations themselves, asset managers, should not, in my opinion, be pledging to support a net zero by 2050 target that's more aggressive than US regulations. I don't think that's their job. And as an asset manager, I think it's my job to maximize risk adjusted returns, period, for my clients. And I think that's where this has gone wrong. It's not that these debates, these conversations shouldn't be happening. It's just, where should they be happening?
And the counterpoint that I would point out is that, one, I actually do think it's totally performative. Two, I actually think the dynamic of having an entity like that is actually designed to create barriers to entry to new entrants more than anything else. And so when you have 150 firms signing on, I guarantee you it wasn't Joe's Pizza Shop that was signing on as a signatory. It was large corporations who are like, hey, this is fantastic. Just like Larry Fink is doing, we're creating barriers to entry. And that's going to enhance our profitability. That's exactly what we've seen. So I am far more cynical than Matt on this.
All right. And now we're coming up on the hour and don't want to take too much more of your time. Really, the final question is the same for both of you. And it's, if you want to bring something up that we didn't get a chance to talk about today that you think is very important, you can bring that up and that we should be looking at. And, or, what should we as investors be particularly focused on, say, in the next 12 to 24 months? Mike, you can go first.
Listen, I think in the next 12 to 24 months, the key question is going to be, do we see the credit events that I'm concerned about, or is that delayed until 2025, as Matt seems to think is more likely? That's really the only question that we're struggling with, right? And if we end up seeing the economy slow further and the constraints that are created by credit availability finally begin to bite, and I think it is actually really important to remember that credit doesn't matter until you need it and you can't get it, whether that's for refinancing, whether that is for making a required purchase for equipment that is now broken. None of it actually matters until you get to that point where consumers are turned off by the cost of financing their purchase of your product, for example. In the case of autos, we're starting to see serious evidence of that. Until those things actually occur, it's all a hypothetical discussion. And so I think that's really the key question. What I'm watching very carefully is the divergence between the realized activity that's occurring in terms of defaults, bankruptcies, delinquencies, et cetera. And that is beginning to rise significantly in a manner that's not at all dissimilar to what we saw in 2006, 2007. This is actually much larger in terms of a divergence versus the credit spreads. And that's really going to be the key question, is how that resolves. And, if it resolves in the way that I think of course you'll end up seeing the Fed retreating and cutting interest rates, et cetera. Again, once that process starts, it's really hard to stop, right? If you're entering into distress, the fact that the Fed just cut interest rates by 50 basis points does not actually meaningfully help you refinance. Because at that point, everybody else is scrambling to find the safest ground to put their money in, and that money is very difficult for you to access. So that's going to be the question. How does this play out? If Matt is right, then I'm probably too early in my bearishness. If I'm right, then he's probably too late.
Yeah, it's a timing question, and if you look historically, the average amount of time after the Fed pauses before they start a rate cutting cycle is around 6 months, and so that would be supportive if it's around average of Mike's view of near term concern. If it gets delayed, I do think that will cause some upward movement, upward pressure for equities. But I mean, I think we both agree that we're at the end of a business cycle. So for me, when it comes to risk like that, I'm pretty neutral right now, because I do think that there's a decent scenario that Mike is right. And even though my base case is that it's delayed and pushed out towards late 2024, early 2025, that's not a scenario where you're looking to take outsized risk. And so right now I'm neutral. If we do get what I'm thinking and it gets pushed out, I'll become more defensive, more actively defensive towards the end. But being defensive is not, it's a pretty tough trade. It's just like in bond space. If you're short carry, you need to both be right on the scenario and you need to be right on timing. And so to me, it's a scenario for neutral with regards to most risk.
And then, Matt, what are you primarily focused on, or what should we be focused on as investors over the next 12 to 24 months? What are you looking at specifically?
It's following all economic data, looking for signs of change. I mean, part of my view is that when you see things like a large yield curve inversion, that's signaling that something's wrong. Personally, I have never been one myself or really seen people to typically accurately predict what causes that kindling to go on fire, what actually causes the next recession. I'm not going to predict the pandemic, but it's more of, we are in a scenario that I think is more sensitive to things pushing us to recession than not.
And with that, I want to thank you both for spending your time with us today. I'm sure our listeners are very thankful as well. Follow each of these people on Twitter. They post a lot of really good information. Of course, follow Place Your Trades to find out what else they have going on over there. And with that, thank you again, gentlemen, and we'll see you next Wednesday.
Thanks, Tracy. Thanks, Mike. Bye.
Thank you.
Thanks.